Welcome to our May edition of Wrap the Month. Let's do it. Okay, the month of May, not the best month. Probably one of the more down months we've had in the past few months, or at least in 2023. So, how did that with your monthly statements? We'll get into why and what's going on with that. Still, in the grand scheme of things, just a normal market environment month. Also, really want to thank all the feedback, comments, suggestions from the first one we did in April. Had a really positive response to it, more than I thought we would. And that's why we actually, we increased our charts. We went from 6 charts now to 11 charts. Some of the charts we're going to look at is what I call offense, defense, which we added, which we'll get into, and also sentiment, which goes over how people feel about the market. Also, too, if you could like the video, that'd be great. I think we only had 1 like last time, and YouTube likes for algorithms and people to find me. And I think the 1 like we had, it was pretty sure is from my mom. So if we can get more likes from people besides my mom, that would be amazing. So without further ado, let's jump into the charts for the month of May. All right, let's start wrapping the month. So what we're going to do, first chart here, as you can see, is our month to market overview, which essentially is what we do. We're going to look at how all of the major indexes performed during the month of May and how a majority of our holdings that are in your portfolios performed during the month of May. So for this month, the NASDAQ was the leader, quite a huge difference there, up 5.8%. S&P 500 was up 0.5%. When we're looking at small cap stocks, we were off 1.68%. And the Vanguard Total Bond Market, which is a major holding that is in all of your portfolios, which is ticker BND, which is more of an intermediate bond. It's a great measure of the total bond market. That was off 1.15%. As we saw bond prices come down a little bit and yields come up. We'll get to that in later charts. So as we can see here, when we're looking at the S&P 500, up 0.5%. What we predominantly own in all of your portfolios is the equal weight. We went over this a little bit last time, but the difference between the S&P 500, which is cap weighting, which all 500 of the companies in there have different weightings, which represents different parts of the index. A really interesting thing that I was reading the other day is that the top 10 holdings represents a huge portion of the total return of the S&P 500, where when we're looking at the S&P 500 equal weight, as again, we went over last time, the S&P 500 equal weight is an equally weighted. So all 500 holdings have the same weightings. Why is that important? Well, that gives us a broader overview on what the actual market is doing, not just what the top 10 holdings are doing or top 10 kind of popular stocks are doing. And it also gives us better exposure to small and mid-cap stocks. But this year, and we'll get into that chart in a second, this year, S&P 500 cap weight is really outperforming the S&P 500 equal weight. So that's something that I'm definitely keeping an eye on. I'm definitely measuring it to see if it makes sense to maybe at some point down the road, maybe swap out the equal weight for the cap weight. But historically, equal weighting has given us a really nice advantage over cap weighting, but this year, not so much. And that's why a lot of you in your statements for the month of May, unfortunately, we did lose a little bit of value, probably one of the bigger value decreases we've had in the past few months. And that's one of the reasons is the equal weight, which is a majority of our holdings, or a big percentage of our holdings, was off almost 4%. Dividend stocks was off 2.74%, which is the Vanguard dividend appreciation. U.S. small caps, like we looked at before, is off 1.68%. International stocks was down 3.47% for the month of May. International small cap, even worse, down 4.54%. And our bond funds were off. The international bond was up. So a majority of our holdings that we own did not have a great month of May, which is why we saw a lackluster month of May. So that is how the major indexes performed. Let's jump over to our market overview and how the markets have performed the past 12 months. Again, we're going to look at pretty much the same holdings we just did for the past chart. So we've got the S&P 500 over the past 12 months is up 2.33%. But again, the leader is NASDAQ, which you'll see is in tech stocks and mainly AI. Artificial intelligence is really leading the way. That's the new thing. That's where a lot of money is going. It's my opinion, it's kind of over bubbled a little bit, but we'll see where that goes. But so we've got the tech industry, tech stocks. The Nasdaq is up 6.63% over the last 12 months. S&P 500 up 2.33. Small cap stocks over the past 12 months were off almost 6%. And the total bond market over the past 12 months, as one would expect with interest rates going up, bond prices going down, is off almost 3%. And then if we're going to jump into our holdings, so we've got our S&P 500 equal weight past 12 months is off 5.35. Vanguard dividend appreciation is up 1. Schwab US small cap off 5.68. Our international Vanguard fund is down 1.12. Our international small cap funds, again, getting beaten up over the past 12 months, down 6.14. And the bond market does not look anything exciting either over the past 12 months. We got short-term bonds off 0.3%, longer intermediate, not long, but intermediate on duration, down 2.73%. And our international bonds is off about 2%. So that's kind of how we're doing the past 12 months. Let's jump into how we're doing year to date. So year to date, we got the S&P 500 is up 9.68%, but whoa, the NASDAQ is up almost 24%. So you can see that there. Small cap stocks are flat, and we've had a little, actually, since January 1st, the total bond market fund was up 2.65%. Let's jump into our holdings year to date. So for year to date, our equal weight is actually flat. It's down 0.66%. Vanguard dividend appreciation is up 1.43. U.S. small cap stocks 0.26. International's been a nice bump for us, up 5.19. And on the small cap international side, 3.81. And the bonds actually have added a little bit of value so far this year, with the short-term bond up 1.8 and the total bond market up 2.6 and our international bond up 3.77. Let's jump into one of the charts that I really like, which is market breadth, which kind of goes over how many stocks are trading above the 50-day moving average, how many stocks are trading above or below at the 200-day moving average. So what we're looking at here is when you're looking at technical analysis and moving averages, you've got the 200-day, which represents a longer-term trend, which is the red line. You have a shorter-term trend, which is represented by the 50-day. So one easy indicator with technical analysis, and this may be one of the biggest ones and easiest ones to follow, is called the moving averages, which again, we have a 50-day moving average and a 200-day moving average. If the 50-day moving average is trading above the 200-day moving average, that's a bullish positive sign. And you can see here back in February, we actually had that cross, and that's called what they consider in technical world a golden cross. It's a golden cross, which means now we've got a 50-day trading above a 200-day, which represents a bullish pattern. Then you see all the price bar charts here. If these bars are trading again above the 50-day moving average, that's another bullish technical sign. But as we've seen, and we went over a little bit with the S&P 500, is a lot of this is being led by a few stocks and a few tech stocks. It's not the market breadth as a whole, which is kind of why we're seeing a lot, not a phenomenal kind of rate of return year, obviously much better than last year. So that's kind of where we are. We are in a bullish positive trend based on the S&P 500. Now let's look at kind of what we call the market breadth. So again, a positive bullish signal is the amount of stocks trading above their 50-day moving average. So right here we have the S&P 500, the percent of stocks trading above the 50-day is only 30%. We have and then when you equate that to 500, that's 150 stocks. So what's really a bullish trend is kind of above, when you're looking at this to really see, you want to be in that like 70 range. So right here is 50. So we're, below 50. So from a market breadth standpoint on the 50-day, it's not an overly bullish thing to scream to, but yet the 50 days trading above the 200-day, which is a bullish pattern. Now, when we're looking at the 200 days, which represents a longer term trend, 50 days represents a shorter term trend, 200 days is a longer term trend. And again, we've only got about 40% of those, which represents 204 stocks that are trading above there. So that's how we're looking at the S&P. Now, if we're going to look at the NASDAQ, which we would think would have a much better chart than we're looking at the S&P, although the S&P has done well this year. The cap weight has done fine. You can see here, well, this chart is screaming bullish pattern. Again, back in about the middle of March, we had that golden cross. We've got the 50-day right here trading above the 200-day. And look at this price chart. Whoop, all the way up there. So we've got positive price momentum. The price is high above there. So you would think a lot of the percentages of above 50-day and 200-day would be screaming bullish pattern, but I don't think that's the case. So when we're looking at the 50-day moving average, we're still only seeing, as of May 31st, only 41%, basically 42% are trading above their 50-day moving average, which does not indicate a bullish market. But again, it's being led by few popular, that kind of artificial intelligence, chat GPT, NVIDIA, that kind of whole outlook. And that represents, 1,400 stocks. Now, when you're looking at above the 200-day, only 32%. So again, not a huge bullish indicator there. So that's kind of what's going on in the marketplace on the NASDAQ when we're looking at breadth. One of the other charts that we went over to last time is what I like to call, we compare value versus growth. Value is more dividends, more blue chip oriented companies, where growth, you guessed it, is kind of more your technology and things like that. And based on the charts that we've been looking at, how well the NASDAQ and tech stocks have done, and you can probably surmise how this has went. So when we're looking at this chart right here, large cap value, which is the Russell 1000, the value side is gotten beat up pretty good in the month of May. So growth outperformed it by 8.21%. So growth is doing much better. So for the month of May, we've got the Russell 1000. So we got the value stocks was off almost 4%, and we got the growth stocks up almost 5%. One of the newer charts that we're going to go over this year is what I like to call offense defense. I didn't come up with this. This again is another popular technical thing where when you're looking at offense versus defense, and to take a sports analogy, when you're on the offensive, you're looking for growth. When you're on the defensive, you're trying to be conservative and stop. And one of the two things to look at in the market is when you're looking at this, consumer discretionary goods versus consumer staples goods. When you look at it, what consumer staples are, they're necessities. It's what you need to survive. It's food, it's toilet paper, it's toiletries, so it's not really exciting stuff. And staples is fun stuff. It's concert tickets, it's going out to eat, it's going skiing, it's booking trips. So when you're looking at markets and trying to understand, are we in a positive economic cycle or a positive market, what you kind of want to look at is staples outperforming discretionary, or is discretionary outperforming staples? And what we're looking at here is for the month of May, staples is underperforming discretionary, which represents a bullish pattern. So we're up about 2%. So staples underperform discretionary by 2%, or another way to look at it is discretionary outperform staples by 2%. That chart had no data, so we won't look at that. Another new chart that I decided to add into here was the University of Michigan consumer sentiment. And what I want to point out here, which is kind of interesting, is this kind of gives us, this is kind of a 30-day lag. So we're looking at the May 1st number of 59.2. As you can see here, is 59.2 means, we've got 60% of the people that were polled in the Michigan poll have a positive outlook on the market. So when you're looking at numbers here of, 51, 62, 97, so the lower the number, the least positive they are among the market. Now, 59 is not the worst we've seen, but over the past, over the past 45 years, it's pretty low. But the interesting thing to look at is when you look at time periods here, typically when sentiment is really high, we've had major corrections. And you can tell that too, just by back in, 99 when we had the dot-com tech crash, sentiment was through the roof at 112, then it dropped all the way to 81. During 2008, you had sentiment up to 96 when we had the great financial crisis. And then that dropped down to 56. You can kind of see charts here and how the yields do. So again, this is another thing. It doesn't mean we need to act on it, but it's another chart that I looked at and wanted to throw in here to you. So, okay, so that's kind of how we're doing on the stock side. Now we're going to jump into how we're doing with yields. And like we've spoken about before, this is a chart comparing whether we have an inverted yield curve. And yeah, we do have an inverted yield curve, and it's only getting worse. So what we're seeing here is that our inverted yield curve, we're inverted by about 0.81%, which means the 2-year treasury in this chart has a higher yield than the 10-year treasury by almost 1%. That's crazy. And if you can see here with the chart going back, that's a big indicator. It's inverted more than it's been, I think, going all the way back to 1980. And then if you just kind of look at how each of them are doing, so the red here is the 2-year yield, which is, about 4.51. The 10-year yield's 3.7. So that's where you see that discrepancy of that point, of that big kind of jump there, of that 0.81. Typically, these are reversed. They're inverted. They're opposite. Typically, the 10-year treasury would be yielding 4.51 and the 2-year would be yielding 3.7. But we've got this inversion going on because of the way that the Fed rose interest rates, and we've gone over that at nauseum, and we probably will keep going over that. But that's where we are with the 10 and the 2-year. And then if you look at the 10-year and the 3-month, it's insane. We can get 5.44% on a 3-month treasury yield right now, but a 10-year one is 3.7. All right, well, that's a wrap on another Wrap the Month for the month of May. Hope you enjoyed it. Remember, give a like to the video. That'd be great. And until next time, see ya.